Hi, my name is Daniel and you're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. Today I'm excited to talk to you about TOPP stock, which is going public via the SPAC MUDS. So MUDS actually stands for Mudrick Capital Acquisition Corp. 2, so it's their second SPAC, or MUDS stock, which is bringing TOPPS public. If the deal closes in the third quarter 2021, it will then convert and it will start trading as TOPPS stock, or TOPP. Currently, though, it's MUDS. So what is TOPPS, and is it a compelling investment opportunity? TOPPS is a company looking to capitalize on legacy brands that have strong emotional or sentimental value. This includes trading cards and candy. They are currently investing in new and exciting initiatives, including non-fungible tokens and blockchain as it relates to trading cards. And this strikes me as a really interesting potential that could really dramatically revolutionize an old business model, which is the physical sales of trading cards. So we'll get into that a little later in this video. Now let's dive right in, sort of going over the whole thing, a detailed analysis on TOPP stock, or MUDS as it currently is. But this is an overview of it, so it should be relevant now as well as in the future if the company converts. Let's dive right in. So here's a disclaimer. You can read it on your own time. So TOPPS used to be a public company, but then in 2007, Tornante Company and Madison Dearborn Partners agreed to take TOPPS private. Tornante is actually run and founded by Michael Eisner, who used to run Disney. The total purchase price for this deal was little less than $400 million. Michael Eisner, obviously working with Disney, has plenty of experience dealing with companies that have a lot of brand value, a lot of brand potential. Fast forward 14 years, and what do you have? You have this new SPAC deal where the MUDS SPAC and PIPE is looking to invest about $570 million into the company, of which $521 is going back to Madison Dearborn Partners. Keep in mind, Madison Dearborn Partners were the same folks with Michael Eisner that took the company private 14 years ago, back in 2007. So the total value for this, actually we'll get into that in a second, but you see the total cash coming in of $570, $521 effectively as a payout to the Madison Dearborn shareholders, and another $50 million for the bankers' fees, because the bankers need to get paid, and that's how these SPACs just keep on happening. So the deal is structured at around $1.2 billion, which is about a 3x investment, 3x the purchase price from 2007, which is, not crazy. While on a dollar basis, that implies about an 8% CAGR, I'm sure they used a significant amount of leverage to do this deal, to do the financing. So, it's perhaps Madison Dearborn and Michael Eisner have had a better return, maybe in the teens would be my guess, based on this price and what they're currently marking it on. So what is TOPPS now after 14 years of private equity ownership? What has changed, or what's going on now? And right now it's a branded conglomerate. They have the legacy trading cards operation with a growing e-commerce platform, which we'll talk about in just one second. They also have interactive apps for digital collectibles and games, gift cards for several leading tech companies, as well as candy, which they call their confections business, which is a sizable portion of the business. Given that the trading business, both the physical and digital, is the vast majority of the revenue, 55% and 6% separately, or over 60% total, I'm going to focus on this primarily, focus on this first, the candy business second, because that's 35% of their revenue, and then lastly their gift card business, which as I'll mention at the end of this video, it seems like it's fairly insignificant, at least from a profit perspective, but we'll talk about that later. So what's special about the trading card industry? People like the perception of scarce assets, and they're willing to pay for them. And here it is, you can see all these headlines. The Mickey Mantle rookie card sells for a record $5.2 million, or the Kobe Bryant rookie card in pristine condition sells for nearly $1.8 million at an auction. People like the perception of scarce assets, something that can potentially increase in value over time due to its scarcity. And one could argue that what people have seen a lot of in 2020 and partially 2021 is this perception of scarce assets getting a bit higher. And so here are several headlines all along that same theme. And as you can see, TOPPS has a special relationship with many top-notch brands with lots of different price point offerings. You can see from $1 to $25,000. So very wide range of price points, but it's also a lot of key brands, whether or not it's MLB or several different types of soccer clubs or Disney content like Marvel or Star Wars or the National Hockey League. So a lot of valuable IP or intellectual property, and you can see the different types of people that are buying it, whether or not it's hobbyists, e-commerce, which we'll talk about in a second, or retail. Now, they're starting to make some exciting investments in e-commerce. What do I mean by that? So for TOPPS now, and that's a relatively new initiative for them, they offer very limited edition trading cards that are based on specific games and moments and are only available for limited prints. So think one-off prints, very set amount of time that you can find out that this is being made. You only have X number of days to buy this on its primary sale. So shortly after you make the order and you purchase it, you do get a physical copy. So you see something, maybe you watched a game yesterday, and then the next day there's the TOPPS Now that shows a clip from the game, and now you can order it, and a few weeks later or a few days later you get a physical copy of it. Now, it's based on the moment, the who, the what, the when, where. The price of some of these cards can range up to several $1,000s. Here's one that's just going back over Derek Jeter's career from several decades ago. This is 1996, I believe, playing card. And you can see the amount, it's a lofty $1,200. It's very rich, but it also has this sort of pressured buying tactic where you see that the range, the time frame is that it's 25 days for this print. You get this signature, and they say that it's been officially signed by Derek Jeter, and you get it 5 to 7 days after the expiration date after this countdown clock goes wraps up. Now, this line of business, this e-commerce business, because people are going online to order it, and it's sort of this new special, like, hey, you just watched the game, will there be this new function or this new card that you can get? This has been a fast-growing part of their business, growing from $5 million to $92 million in revenue. So I'd argue this has been one of the core drivers of their revenue growth in the last few years. But they're only starting here. They're also looking to rapidly sell their licensed content via non-fungible digital tokens. As management has explicitly called out, they'll sell fewer digital copies in their primary sale or their first sale, so that their secondary sales can be 10 to 20x higher over time. So let me make sure I repeat this. They are looking to sell much fewer digital copies of these assets in the future, so that way when they sell in the secondary market, so someone has a digital copy and they want to sell it, the value for it can be 10 to 20x higher over time. Now, this is at least what management has articulated. Now, why would management care about higher sale prices for digital assets? Why would they want to sort of create environments where digital tokens of, let's say a sporting event can dramatically appreciate in value over time? Why would you only create a limited edition of these things and keep it very small supply so that way it can get multiplied 20x in the future? Why would they want to do that? And the answer is that by using blockchain technology to create these non-fungible tokens, they will continue to receive a piece of the pie or piece of the price for each subsequent sale. So unlike physical trading cards, there's no benefit of them to them when, let's say, the rookie Kobe Bryant card is appraised at $2 million. Here, with digital assets that they can track and they can structure it such that they get a cut of that future digital appreciation. So that means more revenue, effectively creating these revenue streams for them by limiting the amount of this digital production. So it's a really interesting take on the business model, because historically it's just been driven off of the primary sale, whereas now they're going to try to get a cut on the future sales as well. So while While their business, sports and entertainment business, represents about 60% of their revenue, let's move on to their candy business, which is another 35% of their business. So those two segments between sports and entertainment and candy, that covers well over 90% of their revenue, so the vast majority of the business. Management describes these legacy brands as edible entertainment. I personally find this description funny, as usually when I think of edible entertainment, I think of this, but maybe that's just because I have the mind of a teenager at times, a teenage boy. Now, their candy business is primarily spur of the moment, where you're about to check out of the retail grocery store. Maybe it's a 7-Eleven, maybe it's a Dollar Tree, maybe it's a Safeway, and maybe you're tired, it's the end of the day, and you just want to reward yourself with a little treat. Many of these brands have been around, as I've already articulated, for decades, whether or not it's Bazooka Bubblegum or Ring Pops or Push Pops. And like Bazooka Bubblegum's 74 years old. But it's a profitable but slow growth business. Honestly, no matter how much you want to spin the segment, and management's trying to say, hey, we're going to be tapping into new markets, potentially Russia and India, I'm just not super excited about this business. Just given that it's been around for several decades, how many new spins on Ring Pops can you really do that gets you excited about their growth? And, management seems to have similarly low expectations with only single-digit revenue growth forecasted in the years ahead. One should call out when you're looking at this business, the confections business or candy business, did decline by about 10% in 2020, but that's primarily, I suspect, due to COVID, as there were fewer store trips happening and fewer sort of last-minute purchases as people were checking out in the candy aisle, which, a 10% drop for a business that's sort of the spur-of-the-moment purchase, that's pretty impressive that it held up as well as it did. So their last segment is this gift card segment, which management describes as being a soup to nuts solution for major tech brands, like Airbnb, Uber, and Netflix, that want access to an easy consumer-to-consumer gifting solution. This is similar to the candy business in that I just don't see how this becomes a high-growth segment in the years ahead. Now, what do I think about the valuation? Do I still think that this valuation is compelling at this price, and am I interested in buying? Now, before jumping into this valuation, please make a point right now to subscribe to this channel if you're enjoying this video and you're enjoying learning about potential multi-baggers or the types of stocks that can potentially go up hundreds or thousands of percent over time. That's the whole goal with this channel. At the end of the day, finding just one potential multi-bagger can change your life journey. So if you're interested in following my journey as I try to find these potential multi-baggers, go to unrivaledinvesting.com, click on Journey, where we're building a community of investors looking for the next potential multi-bagger. Okay, back to the TOPPS valuation. The valuation for TOPPS is interesting. Not crazy, not crazy cheap, not crazy expensive. As I've called it before in some of my prior videos, I think most SPACs are a disaster waiting to happen, but in this case, the valuation really isn't that crazy in my opinion. It's not crazy good, not crazy bad. Of course, the stock price can go higher or lower than this hypothetical valuation framework, but I like to use a logical framework before I consider any prospective investment. So let me walk through a few of these assumptions that I'm using here, and then I'll discuss what am I going to do. So, you can see the implied growth range. This is based on management's guidance. This is the upper end is management's guidance and a lower end for 2021. And then what's the growth rate for the years ahead? I'm assuming 5 to 15%. And you can see what the optimized margins. They're currently around 16% margins. Management's guiding to around 15% margins for the next 2 years. So I think that's an appropriate range. If you look back at what TOPPS' margin looked like back in 2007, you could see it's comparable figures, maybe slightly lower. But this makes sense. You got to factor in the debt they have on board because they have a little under $200 million in gross debt outstanding, and the interest expenses that they're going to have to pay on it. Not quite sure why it's expected to tick up in the years ahead, but I used what management indicated of about $14 million for the looking at the underlying earnings of this business. But overall, what I'm looking at is a business that's growing. Management thinks it's going to grow, around 20% this next year. That's trading at, let's say, a high teens to mid-20s type of valuation. That just doesn't strike me as crazy compelling. But ultimately, the biggest driver is what's your growth in the years ahead, because that growth rate is going to be the biggest determinant of what your valuation multiple is in a few years from now. And as I've alluded to several times in this video, I'm just not quite sure what's going to drive the value, what's going to drive their growth rate to accelerate so dramatically in the years ahead. I mean, maybe they're non-fungible tokens, they're digital playing, trading cards, that business can grow materially in the future, but at this point it barely moves the needle for them. So I just don't think it's there. So when I look at this and I assume an assumed multiple a few years out of, let's say, 12 to 18 times, the valuation just isn't crazy compelling of, let's say, a little over 100% and downside of a little over 30%. So 12 to 18 times given, let's say 5 to 15% growth over the ensuing years. Here it is a 28% tax rate. You should factor in that they are going to generate meaningful cash flow, or at least that's what management has indicated. So if you layer in that additional cash flow, the hypothetical annualized return is a bit better, just given that they will have cash that they can allocate. Management has talked about reinvestment opportunities as well as investing in M&A. So what am I going to do? So normally I would share this next component, as exclusive content for my Journey subscribers, but in an effort to create more goodwill with the YouTube community, here it is. I'm going to share sort of my exclusive take on what I personally would do as I look at TOPP stock, or the MUDS stock. And so let's dive right back in. Where here it is, 2020 was probably better than expected. I don't think a lot of people expected a pickup in trading cards. That's pretty dramatic, like 50% growth in physical sales of trading cards. But maybe that was driven by one-off effects of the stimulus. I don't know. Management's certainly forecasting a dramatic slowdown in that growth, with only 12% growth in 2022. They've already optimized their profit margins over a decade plus in private equity ownership. So this growth rate does limit their valuation expansion in my mind in the future. And so I don't think you're going to have that crazy upside potential over time. It really just depends on their execution, and maybe their digital, this super small component, this dark green of 31 million in revenue, that's going to need to grow significantly really to move the needle. And they are expecting a good fast clip in the years ahead, but still it's not going to be enough to really move the needle for this business in terms of getting a re-rating on the valuation. Some other aspects that I didn't like about the presentation. Overall, I felt like management was not sharing a lot of information that I would have liked to see. Case in point, here they break out their EBITDA by segment, and I'll shrink myself a little bit more. And you could see their EBITDA by segment. You could see their revenue by segment. So revenue by segment, physical sports and entertainment, digital sports and entertainment, gift cards and confections. But they only break out their EBITDA by sports and entertainment and confections. They don't actually break out their gift cards EBITDA, which is very weird to me. Maybe it suggests that they don't expect EBITDA to be profitable in the years ahead. It's not currently profitable. Maybe it's unprofitable. Why don't they share that? It just strikes me as weird, and one of the several examples where management could have shared more but clearly chose not to. I also, going back to this, it really bothers me that they're only showing 2019 revenue, and I think this would probably kill significant part of the bull thesis if people saw, let's say, 2018 and 2017 revenue, and if it just wasn't fast enough growth, or let's say if it was stagnant, then maybe in that case people would say, well, wait a second, this is just a one-off uptick. This doesn't warrant the current valuation that it's currently getting in the deal. So I talked about the gift card EBITDA, how they're not even disclosing that. Honestly, as I look at this business, I strongly suspect that this business would just be ripe for splitting it up. Like there's the candy segment. It doesn't really make sense why it's with a trading card business, this gift card business. It just doesn't really make sense in my opinion. And the gift card business was something that they acquired. How much did they acquire it for? What was the historic valuation? Is that a potential write-off? There's all sorts of questions I have here that it just doesn't make sense, this story, to me. It's not super compelling to me. Now, I recognize that's how the company historically was, and historically it was candy and trading cards business, but that doesn't mean that's what it needs to be going forward, and you could probably get a better value if you split it up into these different pieces. Another one-off weird thing is in their 2019 figures, they talk about a loss on a sale of a subsidiary. This was clearly back when it was private equity ownership. No idea why. I'd love to know what that subsidiary is, a little bit greater detail. I'd love to also know, I'd love to see their actual free cash flow, the actual cash flow statements, and they didn't provide that either. Because like they're saying their net income jumped, from 8.8 to 83 million, but here it is in 2020. It's including this 2020 number is like an adjusted number, even though they're saying it's actuals, and that bothers me as well. Like, is this 83 million actually lower, or higher, or because they're including public company costs here, and clearly it's not public company yet, so why would they put that? Now they do put a footnote, but it just doesn't, the way they laid this out just doesn't make sense to me. It'd be better just to have an adjusted EBITDA figure year after year versus putting public company costs in 2020. It doesn't make any sense. And then, I look going back to the valuation, and I'm just not crazy compelled by it. I'm not crazy. I'm not crazy about the low growth. I would be fine with low growth if I was getting a cheaper valuation, and I knew that if I knew for sure that management would be really astute with their capital allocation. But so far, only data I have is that they have a subsidiary write-off over here, loss on sale of a subsidiary in 2019. So I don't really have context for what, how great of investment allocation decisions you have. I mean, what I do know is that this asset effectively compounded at 8%. This is before you factor in leverage, from 2007 until, till now. So that's not crazy great. It's sort of kept up with market while, maybe a little bit better than market while having, while not having the liquidity of being able to invest in the market. I just think at the end of the day, so you don't have management that's proven themselves in terms of capital allocation, in my opinion. I'd love to see some real cool deals, in my opinion. And the valuation just doesn't strike me as crazy compelling. I think, regular Unrivaled Investing Journey subscribers, they know that I call out potential multi-baggers each month when you go to unrivaledinvesting.com journey. And, I think the investments that I consider for my own personal portfolio generally are a better risk reward than this, and certainly the potential multi-baggers that I call out each month, I aim to have a better risk reward than that. For that you do need to go to, as I mentioned already, unrivaledinvesting.com, and I hope this video on TOPP stock, or MUDS currently, MUDS now, will be TOPP in the future, or TOPPS current, the business. I hope this has been helpful for you. If you enjoyed watching this video, please make a point of subscribing and hitting that like button. Thanks so much for watching.